Hey, this is Chris. Today in this video, I'm going to be talking a little bit about inflation. I'm going to be talking about how you can get ahead with your investments ahead of inflation, the impact of inflation if you don't get ahead of it, and then some of the investments you might consider in your portfolio for different types of inflationary environment. So first of all, what is inflation? Well, inflation is the general rise in prices over time that erodes ultimately the value of your money. So if you have a look at, for instance, petrol prices since the 1970s, on average, they've risen by about 5.9% per year. That is inflation in petrol prices. But if you just look on a broad range of different goods and services, inflation has turned what was worth $100 back in 2000 to around $60 today. And so unless you're investing or making your money work harder than inflation, the value of your money or what you can buy with that money is constantly going backwards. And that's particularly relevant and important in today's environment because inflation in a lot of markets around the world has just reached a very high level. So in the US, inflation just hit 7.5% per annum, which is the biggest that anyone's seen in the last 40 years. And in Australia, it ticked over 3% per year, which is higher than we've seen for the last decade and above the band that the RBA is comfortable with, which is the 2 to 3% range. And so when inflation is higher, you want to be even more cautious about what you're doing with your money to make sure it can stay ahead and you can continue to buy the things you want in the future with the money that you have today. And so I'm going to be talking about some of the different investments out there and how they act in different inflationary environments. I'm going to be particularly focused on an environment that a lot of people are worried about at the moment, which is a stagflation environment. So a stagflation environment is one where inflation is high and rising and growth isn't very high or it's not going that well. And that's different to an environment that inflation is rising with growth. And there'll be different assets that perform well in these environments. So first of all, shares. Now, shares are a popular way to protect your money against inflation, and certainly over the long run, shares as an asset class have beaten inflation. So if you look at the returns of the market index over the long run, around 10% per year, well ahead of long-term inflation. However, in the short run, shares don't always perform well when inflation is rising. What we've seen is in previous episodes of stagflation, some pockets of the share market do quite well. Gold shares and commodity shares usually do all right because the prices of those underlying commodities are rising and they're able to pass on that cost and earn extra income. But there are other sectors that are less immune to inflation, either because they feel the cost pressures and they can't pass it on to consumers, or they can't increase prices at the same rate of inflation. And the third impact that often negatively impacts share prices is what's known as the discount rate. And the discount rate is basically the rate at which investors reduce future earnings or cash flows back to today's values to work out what a company is worth. And in periods of high or rising inflation, people put less emphasis on future cash flows because they're worth less once you bring them back to today's values. So generally high growth companies, companies with a lot of revenues out in the future don't perform very well in periods of high or rising inflation. And that's definitely what we've seen over the last few months when it comes to high flying tech stocks in Australia and overseas. They've been punished by markets on the view that inflation will erode the future value of their cash flows. So shares are a bit of a mixed bag. I would say generally property and fixed income are more on the negative side, because they typically are very long duration assets where investors are looking well out into the future and discounting future cash flows back. They generally don't do very well, particularly in a stagflation environment where we're not seeing a lot of growth, but we're seeing high inflation. Look, we haven't seen that in residential property yet in Australia, although we've started to see some prices cool off. Certainly in the bond and fixed income markets, we've seen a lot of weakness over the last 6 months as investors price in future interest rate increases in order to neutralize the inflation that we're seeing, and that's impacted bonds quite negatively. The last asset I wanted to talk about is gold. Now, this is one that we have in all of the Stockspot portfolios, which historically at least has been a great way to protect against inflationary environments, particularly stagflation environments where growth is pretty low, or environments where there is inflation but real interest rates, which is inflation minus interest rates, interest rates minus inflation rather, is negative. So there's negative real interest rates, which means that people's purchasing power is going backwards once their money, considering interest rates has been considered. So gold is actually a good protector for stagflation environments. And if you have a look at one of the biggest episodes of stagflation, which was in the mid to late 70s, early 80s, gold did fantastically over that period, and most other assets did poorly. So that's looking a little bit at a stagflation environment. Now, stagflation isn't the only environment of inflation. There can also be an inflationary growth environment. That's one where inflation is rising, but growth's also rising. Look, in that environment, you're probably going to see a different group of shares go very well. Generally, commodities do very well in that environment, commodity prices as well as commodity shares. And because emerging markets have a lot of exposure to commodities, emerging markets can go well in that environment. And then you've obviously got periods where inflation is low or falling. Those are environments generally where either fixed income will go well, if it's coupled with poor growth, or actually US shares and global shares will do quite well if low inflation is coupled with good growth. And that's what we saw for a lot of the 2010s. So how should you protect against inflation? Well, my advice is actually not to position your portfolio for any one particular inflationary environment. The reason for that is it's very difficult to predict what environment we're going into, how long it's going to last, how much prices have already anticipated that. Our view at Stockspot is to diversify across a range of investments that will do well in different inflationary environments. And there'll always be, therefore, an investment doing a bit better and one doing a bit worse. That's perfectly acceptable. That's just how diversification works. Look, what we've seen in the start of 2022 is gold's done very well because people are worried about stagflation and a low growth, high inflation environment. That's very different to the last 5 years or so where global shares have done very well in a low inflation and high growth environment. So have a balance of different investments that can cater for different inflationary environments. But ultimately, a diversified portfolio is a great way to stay ahead of inflation over the long run.